This week, the market touched 7,000 on the S&P 500 before retreating to close below it. Microsoft collapsed 10% in a single day after spending $37 billion on AI infrastructure. The Fed held rates steady, but removed language about labor market risks. Bitcoin dropped 5% to two-month lows. Healthcare stocks crashed on Medicare policy changes. Most traders see chaos. I see predictable human behavior creating exploitable patterns. The crowd believes markets move randomly. They don't. Markets move because humans consistently make the same psychological errors under pressure. Fear, greed, and the desperate need for certainty create recurring inefficiencies that disciplined investors can exploit systematically. Today I'm breaking down exactly how this week's volatility reveals 3 specific behavioral patterns you can use to your advantage. Let's examine what really happened. The Microsoft earnings reaction exposed the fragility beneath the AI consensus. The company beat estimates but spent $3 billion more than expected on infrastructure. The 10% collapse wasn't about the numbers. It was about the sudden recognition that AI returns remain uncertain. For 2 years, investors anchored to the AI narrative without questioning the timeline for profitability. One earnings report shattered that comfortable assumption. This is exploitable because crowds cling to narratives until reality forces recalibration. The system rewards those who recognize when consensus becomes vulnerable to any contradicting data point. While others panicked about AI spending, the disciplined observer noted this was narrative correction, not fundamental breakdown. The Fed's statement modification revealed the second pattern. They removed asymmetric language about labor market risks, signaling a shift from accommodation toward neutrality. Markets had been conditioned to expect dovish support. That support is now conditional. The Kevin Warsh nomination as Fed chair amplified this uncertainty, introducing a new variable participants must price without precedent. History shows humans consistently struggle with regime changes. They prefer known probabilities to unknown distributions. The overnight futures decline followed by partial recovery reflected this uncertainty being priced in real time. The Stoic approach is to recognize that personnel changes matter less than structural forces. Fed chairs respond to economic data. They don't control it. The healthcare sector collapse demonstrated the third pattern. Medicare Advantage rate disappointments triggered 20% declines in major insurers. This wasn't a black swan, it was a gray rhino. A known risk ignored because it hadn't materialized recently. The magnitude reflected not the policy change size, but the degree of positioning complacency. Second-level thinking means recognizing that policy risk is always present, even when dormant. The crowd had overweighted healthcare as defensive without maintaining proper margin of safety. Systematic deleveraging amplified the initial shock as correlated positions unwound simultaneously. The earnings season data tells a deeper story. Companies beat estimates at an 83% rate with 17% earnings growth. But this growth came from margin expansion, not revenue acceleration. Revenue grew less than 8%, barely matching nominal GDP. Companies are capturing their economic share but not expanding it. The system is pricing continued margin expansion while input costs build pressure. The elevated producer price index reading challenges that assumption. This creates opportunity for those who focus on sustainable drivers rather than headline beat rates. Technical breadth contracted from 74% to 64% of stocks above their 50-day moving average. Breadth leads price, and this deterioration warrants attention. However, breadth can stabilize if underlying drivers remain intact. The crowd reacts emotionally to every technical shift. We remain disciplined and monitor it as one indicator among many. Bitcoin's decline to 2-month lows destroyed the uncorrelated asset narrative. The cryptocurrency that promised structural differentiation delivered cyclical correlation instead. Assets that claim independence in theory often become highly correlated when liquidity tightens. This isn't asset failure, it's narrative failure. The week's action was neither bullish nor bearish, but transitional. Markets are shifting from certainty about Fed support and AI growth to uncertainty about both. This transition creates volatility, and volatility creates opportunity for those who maintain discipline. The Stoic investor understands that markets oscillate around equilibrium, they don't move toward it. The amplitude of those oscillations depends on uncertainty levels and positioning concentration. We don't forecast outcomes, we observe, adapt, and exploit the inefficiencies created by others' need for certainty in an uncertain world. If you value systematic thinking over emotional noise, subscribe for weekly market analysis that cuts through the chaos. Download the complete Stoic Exploiter framework from the link below to master these behavioral patterns and build unshakable trading discipline.